Hello everyone, my name is Radovan Vojtko, I'm head of research and CEO at Quantpedia. So, what is the topic of today's video? We at Quantpedia, we are trying to go through academic research and find the papers that are interesting and very useful in ordinary life of portfolio manager and traders and proprietary traders, etc. etc. Some of the papers are published as strategies in our database and some of the papers are reviewed on our blog. And what I would like to do in this video is go through 4 papers that were published on our blog and I think are very interesting and very useful, and I would like to go and review all 4 of them and show you what are the results of those papers. Those papers were published approximately during the last month. This current video will be like insights into the academia and what is new in the academia. So firstly, we have a new paper from Matthias Hanaver, Amar Sobhak, Mark Stam and Tobias. I'm sorry for Tobias, but I'm not trying to pronounce his surname. The question is, are the sector-specific machine learning models better than the generalists? So those 4 authors, they build a lot of the machine learning models. They build machine learning models for the US stocks. And the main question was, let's imagine that we train the models from all of the industries irrespective on all of the stocks. Those models are usually called the generalist models. And then imagine another kind of the models, specialist models that are trained separately between each of 12 pharma and French industries. So you can train the model inside of the industry or through all of the stocks. The question is, which model performs better? We are talking about machine learning, of course. What is the answer? The answer is that the hybrid model that combines the benefit of both performs the best. So not the specialist model, not the generalist model, but you need to build a hybrid model that applies industry level normalization to returns and features. It removes the sector specific biases, but retains the full dataset during the training. You need to design the special model, which is like the hybrid between the generalist and between the specialist to have the best performance. So this is very interesting insight when you are trying to build machine learning models. Here we have a quick curve and we can see that the hybrid models are really the best. The second paper is about how global neutral rates impact currency carry strategies. So in the last 20 years, we have a special situation. So with the higher yields at the beginning or during the 2000 to approximately 2008. And after 2008, after global financial recession, global yields or global neutral rates went really down and they were depressed for 10 years. And after the surge of the inflation in 2020, 2022, the yields are once again in, 4 or 5% range. What is the impact on the currency carry trade? What the paper shows, or what the research shows, is that the impact of neutral rates on currency carry trade strategies is really high. The authors find that the periods of lower average global neutral rates are associated with reduced returns from all of the carry trade strategies. On the other hand, when the long-term interest rates are higher and are more divergent, carry trade strategies tend to generate significant returns. What is the takeaway from this? We can expect probably better returns from carry trade strategies. So it's a good time to add those strategies into your portfolio. You can expect from them significantly better performance than in 2010, 2015, 2020, when the global rates were depressed and carry strategies did not perform very well. This is the spread for all of the carry trade strategies. Here we can, what is the expected performance when we have the high spread and high global neutral rates, and here is expected performance from the low global neutral rates and low dispersion. So it really makes sense in this current situation to add some carry trade strategies, because right now the situation is significantly better than 10 years ago or 5 years ago. The third paper, it's from David Blitz and it's about the Magnificent Seven. I believe everybody heard this shortcut or this calling. So what is the Magnificent Seven? Is the 7 biggest stocks in US market. All of them are tech or tech related stocks. So what are those stocks? It's Amazon, Google, Alphabet, so the Google, etc. And they are really dominant. I mean, it's not the first situation like this. The US market has the periods in which there is a certain sector or certain stocks are really dominant. What is tricky with the current situation is that this current situation has a very strong impact on factor strategies. Once you have such big companies and you do the sorting, here we can see what is the weight of top 5 or top 10 stocks in the MSCI World Index, and we can see that it's really high. What can happen in the situation when you are running the factor strategies is that you can sort based on some factor, fundamental factor or technical factor, and you go long stocks and you go short stocks. But few of the really big mega cap stocks can be in the long position and a few of them can be in the short part of your portfolio. And at the end, your portfolio shrinks from being diversified in the long leg and being diversified in the short leg to being long few mega caps and being short few mega caps. So instead of having portfolio that's, let's say, neutral to idiosyncratic risk, you have a portfolio that's very sensitive to idiosyncratic risk because the weight of such mega cap stocks is really high.
Unlock the power of Quantpedia Pro with over 900 premium strategies extracted from 100,000 research papers and more than 30 quant reports. Model full portfolios, generate real-time reports and save hours of work. Quantpedia Pro, your edge in quantitative investing.
What is the solution for that? You do not need to use the value weighting or market weighting in long leg and short leg of the market portfolios. We can use equal weight or even some other type of the weighting. So sometimes it's better to underweight mega cap stocks. Of course, when you are buying just the index, you cannot be without those mega cap stocks because you will probably underperform. But when you are running long short factor strategies, you can decrease the weight and decrease the idiosyncratic risk of such stocks. So this is the important. The mega tech stocks, they have really big impact on the factor strategies, and be aware of that. Okay, and the last paper is from Rob Arnott and Edward McCrory. It's about the asset pricing. We have the capital asset pricing model and efficient market hypothesis. In this hypothesis, we have the idea that when we are taking more risk, we should have the higher returns. The risk in this case is usually higher volatility or some asset that's more volatile. So I mean, if you are buying the assets which is more volatile, we should have a higher performance. But there are like a lot of the papers that shows that this is not the case. There are some papers that are safer and they have the better performance than more risky assets. So question is the why, and the authors describe that what is important is not the risk, so the volatility or something that can be very easily quantified, but more important is the fear. You can have a fear from missing out, so you can have a fear on the positive side, and you can have a fear of loss. I mean, the fear is different emotion than the risk, and the fear causes all of the other kinds of anomalies like a low volatility anomaly, skewness anomalies, and all of the other kinds of the anomalies, and the fear explains asset pricing better than the risk. When you are building risk-based models or I don't know, factor-based portfolios or whatever, I really recommend you to go through the paper from Arnott and Edward McCrory. It's not a long paper, it will give you the nice perspective. Thank you very much, I hope that you liked the current video. We try to do it a little differently, so instead of just looking at one paper or one idea, we try to skim and go through 4 papers. All 4 papers and all 4 reviews are in the description of the video, so I hope that you liked it. Please, if you liked it, give us the like, subscribe to our channel, reshare the video, and visit Quantpedia. You can visit our blog or you can visit our screener, and what we are trying to do is we are trying to give you the better orientation in academic research when you are the portfolio manager or a trader. So thank you very much and see you in the next video.
Are you interested? Then pick another video to learn more, or subscribe to Quantpedia Pro and try how our analytics and reporting significantly save time spent on quantitative research.